Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stenivek on Bloomberg Radio.
All right. Disgraced financier Jeffrey Epstein appeared to allege that Donald Trump spent hours in a house with one of the late sex traffickers' victims and suggested that the president was aware of his activities in emails released today, Tim, by congressional Democrats.
With more on what was released and what we know, joining us is Jamie Tarabay, Bloomberg News national security reporter, joining us from the Bloomberg News Bureau in Washington, D.C. Jamie, these emails that we're talking about, what exactly were in them? Give us the time period, what information and details we were able to garner from them.
Hi. They were released. One of them was a 2011 email that Epstein had written to Ghislaine Maxwell, who, as we know, is in jail for her role in helping Jeffrey Epstein abuse and potentially traffic young women. And one of very early up in our story, we say, I want you to realize that dog that hasn't barked is Trump. Without specifying, of course, that he was referring to the president. And he went on to say that a victim had spent hours at my house with him and that he has never once been mentioned as in the middle of everything that he was dealing with, the name of Trump had been kept out of the spotlight. There's more. There's a back and forth between Jeffrey Epstein and the author Michael Wolff. Michael Wolff suggests that he could use his connections and his knowledge of what Trump may or may not have done with him regarding these victims as leverage as he was preparing himself to run for president. And there was also a conversation in later documents that were released this morning between Wolff and Epstein about doing a CNN hit about Trump right after or before he was before President Trump. Donald Trump was about to do a presidential debate on air. So it's very interesting because obviously this is coming on the first day of most of the House returning to D.C. and the government on the verge of being reopened. It's also a huge signal that whatever it is that whatever lull had happened in the questions over the Epstein matter, both Republicans and Democrats have been trying to seize the narrative in these releases of files. The House Oversight Committee, which is chaired by a Republican, literally sent out dozens and dozens of files this morning without any real kind of explanation of what they were. Some of them were spreadsheets that didn't really make any sense. There was a video of a dog with a doll of Donald Trump and a doll of Hillary Clinton, which was very strange. And then the Democrat members of the Oversight Committee sent out more emails that they were seeing as well. So clearly they've been getting thousands and thousands and thousands of documents, and one side of the aisle is being very circumspect about what they're sharing, and the other side of the aisle is being very deliberate about what they're sharing with everyone.
To be fair, we noted that in the story, too, that we put out on this, that back in July, President Trump told reporters that he had nothing to do with the guy and that he never went to the island, referring or appearing to refer to the properties in the Caribbean that belonged to Jeffrey Epstein, where it is alleged that the financier sexually abused and trafficked young women. How do these emails, perhaps, do they clearly contradict some of the current thinking about the relationship between Donald Trump and Jeffrey Epstein? Because it's not like it's an email between Donald Trump and Jeffrey Epstein. So, we're all just being smart and careful here. So I'm just curious.
I think that being smart and careful is probably the only thing we can do right now. And we're not really, but it also, what it really kind of speaks to is the unending curiosity about this case and the reality that unfortunately for the White House, no matter how much the president has tried to divert or dismiss the focus on the Epstein matter, that as long as everyone believes that there's something that's being hidden, those questions will remain, and to release things piecemeal isn't going to satisfy so many people who include themselves in Trump's base of supporters. And to have it come on this day, on the day when Adelita Grijalva, who was elected to represent her district in Arizona in September 23rd, today she is finally going to be sworn in, and she has said she is going to be that last barely essential, necessary signature on the discharge petition that would force the House to vote on the release of these files. And then to hear this clamor of activity from the White House, according to all the reporting that we're seeing, according to what Hakeem Jeffries, the Democratic leader in the House, is saying, that people are trying to get the Republicans who voted for the discharge position to withdraw their support ahead of her confirmation, because once she's in, that's something that you can't undo. And so all of this noise and all of this clamor, it doesn't really track with the dismissal of this incident being a hoax and that this relationship being nothing worth noting. And unfortunately, until everyone gets the documents or sees enough to satisfy their curiosity, that attention and that focus and that skepticism is going to remain.
All right. So to be continued, I'm guessing. Jamie, thank you so much. Carefully reported out and covered by our Jamie Tarabay, Bloomberg News national security reporter. She's there in our DC bureau for Bloomberg News.
We should note White House Press Secretary Caroline Leavitt said in his statement, quote, "The Democrats selectively leaked emails to the liberal media to create a fake narrative to smear President Trump." Leavitt also said the victim referenced in the emails had, quote, "repeatedly said President Trump was not involved in any wrongdoing whatsoever and couldn't have been friendlier to her in their limited interactions." Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Treasuries with yields dropping across the curve on bets that the Fed will have room to cut rates next month, that last meeting of 2025, maybe to help prop up the U.S. jobs market. Traders might get some clues. We've got a lot of central bankers out there speaking. We are curious to see what Bob Michele has to say. He's Chief Investment Officer, head of the Global Fixed Income Currency and Commodities Group over at JPMorgan Asset Management, a certainly well-known voice here across Bloomberg platforms, joining us in studio. Welcome, welcome.
Happy to be here.
Well, it's great to have you here. I feel like there's some different views out there, like the tariff angst maybe not completely done. We've got a growing U.S. budget deficit. Bob, we've got a slowing U.S. labor market. How do you see today? Let me throw this in. More Americans falling behind on their car payments. How is the U.S. economy right now? How do you see it?
I think the U.S. economy is just okay. It's not great. I think recession is remote, but it's a little bit squishy. So it feels as though businesses and households are still struggling a little bit with tariffs and the ultimate impact to cost of goods. I think that's a headwind. Certainly the government shutdown hasn't helped with sentiment. And of course, the Fed has highlighted for a while that interest rates are a bit on the restrictive side. And I think all of those things are conspiring to take a little steam out of the economy right now.
The part, the labor market part, is what I'm really interested in hearing from you. Absent government data for a couple of months, what's an accurate view of the strength of the labor market right now?
So the government data is one thing, but you and I both work in franchises which have ungodly amounts of data. We use that. We look at the Chase data. We look how the consumer is performing. The consumer looks okay. Deposit balances look okay. We're seeing big ticket purchases starting to tick up a little bit. But of course, all of that is concentrated in the top quintiles of earners. From businesses, our equity and credit analysts talk to literally hundreds of businesses a day. And what we're hearing there is they don't feel an urgency to do any hiring. They're in pause mode headed into year end. And of course, that would weigh on the labor market.
I want to bring into something that, and forgive me if I mispronounce it, Gregory Dacko. He's chief economist at EY Parthenon Daco. And he says the economy remains resilient on the surface, but it's increasingly dependent on three narrow interconnected A pillars: affluent consumers, artificial intelligence fueled investment, and asset price gains, and talks about how there connected, right? We know the wealthier consumer has been out there spending. They're responsible for really a big bulk of consumer spending that goes on in the U.S. But if the AI spending boom, Bob, is not, if there ends up being a little bit of a bust, a big bust or something, or we start to talk about, right now we're talking about the spending and on balance sheets and, whether or not we're going to have to kind of replace these items. They're not going to last forever, whether it's chips or what have you. But what if we see those asset prices come down? The affluent consumer doesn't feel so affluent. They stop spending. Does all of this start to come undone?
It could, but I think we have to remember we're a month and a half away from the One Big Beautiful Bill Act hitting. And when you look at the One Big Beautiful Bill Act and think about the tax refunds on tips and overtime and Social Security payments, where are most of those? Those are in the bottom couple quintiles of earners. So you're going to get some relief there. You think about the Genius Act and a lot of things that are happening there, you're going to see some spending there. And the one thing nobody's really talking about right now, which we see on the horizon, is deregulation. It's certainly going to come to financial services. It will likely come to other industries as well.
Well, that makes me think about, and we weren't going to talk about this till a little bit later on, but we do know that President Trump is hosting a little soiree with a bunch of financial executives. Jamie Dimon's going to be there, at least according to reporting or people who have been briefed on the event. Is that what they're going to talk about? The regulatory environment? Have you talked to Jamie about this? But if you were sitting down with the...
When I looked at some of the attendees, I suddenly thought, boy, there's going to be one outspoken bank CEO there.
Rhymes with...
I'm sure they're going to do a lot of listening. I think they're going to be a sounding board for a lot of things, the things that have been mooted in the market recently, $2,000 payments that go out, checks get cut, 50-year mortgages, maybe not, maybe you just take your mortgage with you. I think this is going to be an administration that will bounce things off of them.
Yeah.
I think it will be one that will ask them, what do we need to do to unleash big banking, big business? Are there other things that can be done? And I think there's going to be a group there that will be pretty free-flowing with the information.
For what it's worth, Caroline Leavitt at the White House was asked earlier this afternoon about the 50-year mortgages. She said the administration is seriously looking into 50-year mortgages. I do want to go back to the
Would you buy? Would you recommend investors buy
a 50-year mortgage?
Wait, which side, Carol, are you talking about? Of like someone buying a home?
Become an investment?
I got taught very early, there's no such thing as a bad bond, just a bad price. So it depends on where it gets priced and the features in it.
I do want to go back to AI because Carol...
You didn't answer the question.
Carol asked about,
it depends on price.
no bad bond, just bad price,
right?
okay?
It's secured by a home. I would buy it.
Okay.
I absolutely would buy it.
We were talking about one side of what ends up happening with AI and if there is potentially some sort of unraveling given or bust. What about the other side? What about the side where everything actually exceeds expectations, where productivity increases as a result of this technology, and then potentially we see widespread job losses? Are we looking at the right parts of this right now? Are we understanding where we could see productivity gains?
I think you have to look at it all. And I think you have to realize that unlike the dot-com bubble where nobody envisioned the iPhone 10 years later or whatever, and there are companies without revenue, without even really business models that were worth billions of dollars, you actually have deep-pocketed companies that are either developing or investing in it. And it is everywhere. We see it in JPMorgan, how it's being used everywhere to create efficiencies. You talk to any company now, and they talk about how they operate in real time. They can shift their supply chain. So think about the logistics and shipping. All of that can have some sort of AI overlay to it. How they manage their pricing, that could have an AI overlay to it. And those are two big things that have come out of tariff policy, and already we're seeing AI introduced there.
So what could possibly go wrong here in all that's coming at us?
I always go back to William McChesney Martin, whose comment was,
I kind of wish Tom was here because he would love that.
our job is to take away the punch bowl. And the reality is there's a lot of money sloshing around in the system. Policymakers on the monetary side and the fiscal side are working hand in hand. You may even see the regulatory side as part of that accommodation coming from everywhere. But we're not looking at the next Paul Volcker being appointed to the Federal Reserve. We're looking at people who fundamentally believe that lower interest rates create a level of economic activity which will generate higher productivity. So for me, as long as that's in place, I'm not really worried. I would get worried when you have to take the punch bowl away. Growth and inflation pressures are so high, you have to start draining liquidity from the system.
But you don't think we're there?
No, I don't think we're going to be there anytime next year.
Well, that brings us to one last question. We got the news today that Fed Bank of Atlanta President Raphael Bostic announced plans to retire at the end of his current term in February. We are seeing a changing composition, Bob, of the Fed, new names, more to come. Kevin Hassan telling Carlyle Groups and host of peer-to-peer conversations, David Rubenstein, that if President Trump asks, Hassett will do it. He also said he had high regard for Fed Chair Jay Powell. This changing, though, composition of the Fed, good, bad? How does that help hurt in getting policy?
I think it's
right?
Reality. I think you have to accept that these are political appointees. And believe me, I know that they go into rooms, they work with their staffs, they try to make the very best decisions. But they come with different core fundamental views. And one could be the William McChesney Martin, Paul Volcker kind of view, which is there's too much money sloshing around the system. Get it out of here before we have an inflation problem. A Hans Tietmeyer kind of central banker. And others come thinking, no, we need to be able to create liquidity, make mortgages and housing affordable. That will create economic activity, which gets taxed. There will be productivity that comes out of AI, which will offset that headwind. It's an exciting time to be in the markets, and it's an exciting time to see the way policy makers are shifting around.
Come back soon?
Always happy to be invited.
Okay, we will definitely invite you. Bob Michael, thank you so much. Really appreciate it. Chief Investment Officer, head of the Global Fixed Income Currency and Commodities Group over at JPMorgan Asset Management.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
This is the Bloomberg Businessweek Daily Podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Shares of Cava slightly lower, down about 0.5% in today's session. They are down, though, around 56% year to date. They are also down nearly 70% from an all-time high last December, and nearly 15% of the float is short. Now, keep in mind, the company did report after the close on November 5th, the stock closed down about 2.6% the following day on that news. What the earnings news was? Cava Group cutting its full-year sales growth targets after its foot traffic stalled in the third quarter, and that added to some worrying trends that financially squeezed consumers are foregoing fast casual restaurants. To be fair, we've seen this at some other fast casual restaurants. So back with us in our latest installment of CFO Briefing, Tricia Tolivar. She is the Chief Financial Officer of Cava, joining us from Baton Rouge, Louisiana. She will be featured in an upcoming CFO Briefing newsletter. And then also with us in studio is Nina Trentmann, Bloomberg News Senior Editor. She writes the CFO Briefing newsletter, which you can subscribe to and find at Bloomberg.com/CFO Briefing. Good to have you both here. Tricia, I want to start with you because we actually saw Citi come out, and Cava and Sweetgreen were put on Citi's 90-day positive catalyst watch. An analyst there noting that sales he expects to improve off lows as the U.S. government likely reopens in the coming weeks. I'd love to start there, and welcome back to Bloomberg. How has the shutdown hurt business, and how does it look from here on out if indeed we see the government start opening?
Hi, Carol. It's good to be with you today. Certainly, as we experienced the shutdown and around the middle of October, around the time when people in the District of Maryland and Virginia stopped receiving their paychecks, we did see a slight step down in spend in those markets. Certainly not anything acute, but certainly an impact that we noticed in the business overall. So as we look forward to hopefully a return to work in the near future, it's likely that it will have a benefit But really what we're wanting to do more focused is on the long term, and what that means for Cava to be able to provide incredible food, abundant offerings with amazing flavor that make you feel good while you're eating it and after. And we believe that relevance will continue to drive benefit for the business over the long term. The other thing to keep in mind is that we are anniversarying or lapping very strong same restaurant sales in the prior year, fourth quarter, at 21%. And so that is what's influencing our outlook for the rest of the year in 25. And as we go into 2026, I'm looking forward to the culinary offerings that we have that we can bring to our guests every day.
Tricia, thanks for joining us again. Just wondering, in terms of your view of the consumer, we've seen restaurant chains, not just you, but also others, reporting weaker results and cutting forecasts. What's your view of the consumer from here? We've heard a lot about the K-shaped economy, where sort of well-off people are doing well, but the weaker income bands are just spending less. Is that something that you're concerned about?
Certainly, you can see from the high frequency data with credit cards that the consumer is feeling some more pressure, as well as just the consumer sentiment in general. There have been a lot of challenges as the consumers are facing them in the near term. And as we experience those in our business, what we're finding is that consumers continue to lean into our premium items. So our amazing steak and our new chicken shawarma, as well as attaching with incremental items like our fan favorite pita chips. Right now, we've got cinnamon sugar pita chips with a drizzle of honey that's incredibly tasty.
I'm hungry.
As well as our fresh. I know. I had them for lunch today, so they're incredible. But they're that, as well as our house-made juices. So those are continuing to attach and increase. And also, when you look at our restaurants and at how they're positioned based on median household income in their markets, we're finding that the lower income consumers actually experiencing in those restaurants higher same restaurant sales than the rest of our cohorts of restaurants. So from that standpoint, it's encouraging to see that we are becoming more accessible for the lower income consumer and driving increase in sales in those areas.
How does the weaker results that you reported in the quarter, how does that impact your planning on future growth? Like, I know that you wanted or are planning to open as many restaurants next year, roughly as you opened this year. Is that still the plan?
We do intend to continue to increase the opening of our restaurants with at least 16% growth in restaurants in 2026. This year, we'll open at least 68 to 70 restaurants. And what we're seeing is that despite the challenges we see with the consumer today, we're very encouraged about the strength of the business and what we're able to offer. So our new restaurants that are opening or have opened in 2025, those restaurants are delivering average unit volumes above $3 million, which is above our chain average. And that really underscores the power of the brand itself, the excitement around the consumers as we come into new markets and existing markets, and gives us the confidence in our white space opportunities that we will continue to lean into our growth in new restaurants as we move forward.
Certainly new restaurants are a big part of CapEx this year and next year, but where else are you investing?
We're always looking for ways to make our operations and our restaurants easier to run for our team members. So some of the investments we're making are in equipment in the restaurants to streamline operations, like our kitchen display systems, which works with our digital ordering systems on the back of the house, which supplies our digital customers. Those tools allow our operators and team members to fill orders more easily and create a higher level of accuracy. We've also equipped our restaurants with Turbo Chef ovens. Many of our restaurants didn't have them, and in this year we made those investments. It streamlines cook times, creates better quality and efficiency, and simplifies operations for the team members overall. Our view at Cava is a happy team member equates to a happy guest and a happy P&L, and we're always looking for ways to reinvest in the business to drive that.
Let's talk P&L, and I'm just curious about, in your earnings, tariffs talked about how they have hit your or you guys talked about how tariffs have hit your restaurant level profitability through higher food, beverage, and packaging costs. Is that just the new reality and new normal that will stay with us for longer or perhaps forever? I'm just curious what your read on that. And then how does it play into pricing? Because I think you guys were still looking to limit price hikes now and also into 2026, but is that maybe up in the air?
Yeah, so tariffs have certainly been an evolving and an ever-changing area. Luckily, one of our values is to act with agility. So our team members on the supply chain side have done an incredible job in minimizing that impact as much as possible. But the tariffs did have about a 20 basis impact on our food, beverage, and packaging costs in the quarter. And I expect those to continue into 2026 as well. And what we've done from a pricing perspective is really try to minimize that impact. We took no incremental price in 2025 related to those incremental costs that we were incurring. We didn't believe we should put that on our guests and wanted to absorb that and try to continue to elevate our value proposition, which is quite high amongst our peers. And then as we think about it going into 2026, we're also going to be very mindful about price increases and anticipate very modest increases. Since the end of 2019 to the end of the third quarter, we've only raised price less than 10% below CPI or inflation and less than half of many of our industry peers. And that's something that we feel very strongly about and a trend we expect to continue to do despite the pressures we may experience on our input cost side.
Tricia, so I get that. So it sounds like you are being incredibly and have been mindful in terms of price increases on consumers. Having said that, if no price increases, but you did say that the tariffs have hit you guys on a couple different levels, does that mean margins take a hit? Or where do you squeeze costs out? Is it workers? Is it the supply chain? Where do you squeeze price, some of the cost of this out?
So certainly in 25, we took no incremental price related to tariffs. And in 26, there'll be modest menu price increases. That helps minimize any inflation that we experience on the labor side as well as the input cost side. And then there are other opportunities from an efficiency standpoint as we grow and scale that we will continue to deploy to minimize the impact on the P&L overall.
Tricia, your share price is down quite a bit this year. I'm just wondering, from a CFO perspective, is there room for shareholder returns? Like, are you thinking about buybacks? What's the measure to get your share price back up?
Well, what we've always said since the beginning is this is a journey and a long-term journey overall. And so while the share price can go up and down, we want to remain focused on the business over the long term and what that we can do to make sure that we drive that. And we stay focused on our strategy and committed to that. We'll always explore opportunities to strengthen and maximize those returns. And right now, we're just going to continue to remain focused on the strategy we have at hand, and that is opening and expanding the Mediterranean way across the country and running great restaurants every location, every shift, and deepening personal relationships with our guests with a high-performing team. You
have stores in more than a dozen states in D.C., so this question is dependent on geography, but in general, the labor market right now, our team has reported on Walgreens cutting pay for hourly workers after its private equity buyout. Is the labor market better for hiring people right now?
We're in 28 states in the District of Columbia across the country, and the labor market is one that we keep a very close eye on. And our focus is making sure that we're paying a very fair wage in every market across the country. So I work closely with our operations and people and culture team on a quarterly basis to evaluate our wages to make sure that we're in the top quartile of pay so that we don't have as much pressure on wage and can bring on high quality team members that can lead the future growth of our business overall.
All right, next time you have to send us some pita chips. I'm just going to say, am I allowed to say that?
We can go get them.
We could. Why didn't we do that?
Better go get them, and next time.
I'm just kidding. You're right. We could just scoot out here on not Park, but is it 3rd or Lexington?
There are a lot of stores. I'm looking at the website right now. There are a lot of stores in New York
around us. Hey, listen, Tricia.
708 3rd. Check it out.
She knows. Tricia, thank you so much. Tricia Tolivar back with us, Chief Financial Officer of Cava, joining us from Baton Rouge, Louisiana. And of course, our thanks always to Nina Trentmann, Bloomberg News Senior Editor. She writes the CFO Briefing newsletter. You can subscribe to it at Bloomberg.com/CFO Briefing, and a new one comes out every Sunday.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, we're trying to understand where we are in this economy with a lack of government data, with starkly different signals coming from different segments of the consumer. The latest, and it is one of the most read stories today on the terminal, it's about how more Americans than ever, Carol, are falling behind when it comes to those car payments.
I got to say, we've been talking about this a lot today. With ongoing inflation pressures and the return of student loan bills, millions of car owners are struggling to afford their monthly payments. It's the latest sign of weakness in the United States, in the economy, as the Fed considers the path of future rate cuts. So we wanted some help with what this economy really looks like. We turned to a friend of the program. He is the author of The Confidence Map, Charting a Path from Chaos to Clarity. It's a book that digs deep into decision making. It is super great to have back with us Peter Atwater, President of Financial Insights and Adjunct Lecturer of Economics at the College of William and Mary. He joins us from our Bloomberg, Washington, D.C. bureau. You've been such a good friend, actually, to Bloomberg today. I know we've had you on. I think you've been on The Balance of Power. You're going to be on later on BTV. But we're really glad because this big take, and I feel like your thoughts around this, how many years ago when you started talking about a K-shaped economy, I feel like this is something that the economy, maybe not yet quite markets, but politics, like it is front and center, Peter. So where are we with this K-shaped economy, and why hasn't it gotten better?
So, Carol, it's been more than 5.5 years since I first started writing about the K-shaped economy. And I think what's happened is that for those at the top, the financial markets have been extraordinary. Meanwhile, for those at the bottom, things have just continued to deteriorate, and now compounded by the cumulative effect of inflation on particularly food. You referenced the car loan delinquencies, and that's another sign. And, you know, I think that those at the bottom have this heavy weight, whether it's child care, education, housing. It feels mighty heavy to those at the bottom. And I think at this point, we really don't have a single economy in America. We have two very distinct experiences.
So are we becoming, Peter, an economy, a country where there are a few rich people who are living in a poor country?
I would describe it, as a handful of folks who feel invulnerable in a mounting sea of despair.
Hasn't it been like that for years, though? What's different about right now? I mean, I remember having the same discussion, not with the same data, but in graduate school, in a class about how in the developing world, you start to see economies such as this. And that was what the professor was arguing, where we were headed in the U.S. It's been like this for quite some time.
The gap has existed, but not to this extreme. And remember, Tim, there used to be a sense that there was a ladder, a way to progress from the bottom up through the middle class and into the upper middle class and then into the truly wealthy. And for those at the bottom, that ladder's gone. There are no more rungs that enable them to go up. And I think we have fallen into more of a caste system that, to your point, looks less like the America that many were promised and more like a lot of the developed nations around the world.
So when does it show up, Peter? I feel like we definitely, we just talked with the CFO of Cava, and we definitely saw at Chipotle where they are seeing their business impacted because those who are at the lower economic rung, if you will, when it comes to the U.S. economy are having troubles. And so they're not going to Chipotle or they're not going to Cava and a few other places. But when does this really start to show up in our economy, in the financial markets? Just curious.
So in terms of consumer sentiment, it showed up almost immediately after COVID, when those white-collar workers were able to pivot to work from home. Their confidence was restored. They also got boosts from monetary and fiscal policy. And for those at the bottom, those stimulus checks really just went through them to their lenders, to their landlords. And so this has been ongoing for a long time. And I wouldn't underestimate the compounding effect that time has for those at the bottom. And I think it's showing up in the affordability message that you're seeing now politically.
All right. The other part I want to get to is ask you about is the upper part of the K, because what we're starting to hear, and a chief economist over at EY Parthenon, he says the economy remains resilient on the surface, but it's increasingly dependent, Peter, on three narrow interconnected A pillars: affluent consumers, artificial intelligence fueled investment, and asset price gains. And the concerns again.
That's Gregory Dacco, right?
Yes, okay. Exactly. Thank you. And so the other thing is then, I guess I'm broadening out a little bit because very worrisome what's going on in those who are just struggling to get food on their table or pay their bills. But at the upper ring, and I'm thinking about the broader economy as well, we know the richer consumer is responsible for a bulk of the consumer spending that goes on in the economy, and they have felt upbeat because we've seen stock market highs. And that is a result of, in a big way, all of the spending on the AI build out. It's starting to be questioned, that AI build out a little bit, and replacement, of chips and so on and so forth, and those costs and how they are amortized on balance sheets and so on and so forth. But I guess my concern is, when you look at this economy, is it kind of fragile, even perhaps potentially for those who are even wealthier in this economy?
I think so. And I think that there's been lots of discussion about the circularity within the AI system.
Right.
I think that circularity exists more broadly between the wealthy, AI, and you see that in first-class travel, you see that in a lot of the luxury experiences. And we used to say that the economy is not the markets, but at the upper end, the markets and the economy are now indistinguishable. And we need to appreciate the fragility of overconfident financial markets. If I look at the amount of speculation going on through options and the price to earnings multiples, there are lots of signs that this is a market that feels extraordinarily confident. And ironically, that's where the fragility ultimately rests.
What about this idea of the meritocracy, or the idea that people actually, in this day and age, have a harder time moving in and out of social strata? The American dream is this idea that anyone can come to the United States and succeed regardless of where they start. You argue that that doesn't exist as much anymore. Why is that?
So wealth accumulation happens more slowly. You look at, for example, the fact that it now takes to age 40 to be a first-time home buyer. It wasn't that long ago when that age was 25. And so the wealth accumulation potential for this new generation is far less than the generation before, assuming that housing is a means for accumulating wealth. And so what you're seeing is, particularly with things like childcare and healthcare, the burden on those families starting out is substantially higher than the one certainly I experienced and likely the one you started with.
All right, so how do we fix this? Because it does feel
you have 3 minutes, Peter.
Fix the problems that ail us.
No, I think that policymakers need to be really attuned to this. I think they shouldn't ignore the message of affordability that came out of the New York mayoral election. Mm-hmm. What we're seeing is not a movement to the left as much as a movement down. And I think policymakers really don't appreciate how purple the bottom of our economy is. And it's increasingly purple with rage. So we need to address their shared vulnerability, their despair, because ultimately history shows that when it becomes widespread, those with nothing to lose will gladly go after those with everything to lose.
Do policymakers actually have the tools in a divided country to fix this?
I think they do. I think it requires them to recognize that it is in the best interest of both political parties to address this, because we know that anti-establishment candidates become more popular. We know that progressive candidates become more popular. And so it behooves them to pay attention to this and to address it. And to be clear, those at the bottom are not looking for a handout. They're looking for a hand. They want to see job training. They want to see opportunities that allow them to move up. As we saw from the soybean farmers and the ranchers, they don't want a government handout. They want their products sold. They want to have a real meaningful purpose in this economy.
You know, Peter, I'm thinking of the big take that you did with Sarah Holder that's on the Bloomberg right now. And I guess they were asking, she was asking along with Katerina Saraiva talking about this K-shaped economy not just being kind of the same thing as like measuring inequality. And I'm just thinking about a response that you gave, and you said it's not just inequality in terms of an economic sense. It's inequality in multiple dimensions at once, because for those at the bottom, they have scarcity in education, in healthcare, in childcare, in job opportunity. They have what you termed stacked vulnerability, where the economic piece is just one more thing. And at the same time, those at the top have an overabundance in everything, power, money, influence. And so it's become very difficult for those at the bottom to ignore what's happening around them. It's also something that has accumulated over years, it feels like, whether they were Republicans or Democrats in the White House or in charge in Congress. So is it going to take time for us to get this fixed? Or do the people, like, I don't know. You know, I had a Brit say to me, you're a young nation. You're going to have some kind of uprising or revolution. Like, I don't know. How do you, I understand policymakers going at this, but it seems like it's a big task.
Yeah, I think those at the top ignore the impatience at the bottom. Time moves very slowly when you lack confidence. And I also think that those at the top are largely blind to the human experience at the bottom. And at the same time, those at the bottom are all too aware of the abundance that exists above them.
Well said, well said. And I feel like there's a layer of social media here that also makes it a little tricky and certainly really puts it out there. Peter, thank you so much. Peter Atwater, President of Financial Insights, Adjunct Lecturer of Economics at the College of William Mary, joining us from the Bloomberg Washington, D.C. Bureau. He is the subject of the Bloomberg Big Take, which talks all about the K-shaped economy.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.